Hey, this is Lito, and in this tutorial I'm going to show you how to use Aave. Aave is one of the coolest applications in DeFi, hands down. Aave is a decentralized money market, or in more understandable terms, it's a lending platform. It allows anyone in the world to deposit an asset and earn interest automatically as soon as you deposit. On the other hand, people who want to take a loan, want to borrow funds, can just come to Aave and ask for a loan, and then Aave will hand out a loan without having to do any KYC, so any like identity verification, without having to look at the credit history of that person, and anyone in the world can use it. So that's the idea with any decentralized finance application. But here in this specific instance, it's very useful because, people, for example, in developing countries have access to a stable currency like the US dollar, a dollar stable coin, and can then invest it into Aave and earn an interest rate for it. This is super interesting if you live in a country where A, your currency is inflating, and B, you don't have access to a healthy financial system. So this Aave here is really like a savings account, just that it's decentralized and accessible from anywhere in the world. You see that this is not like some dodgy little project. It actually has like $16 billion of funds under management. I haven't double checked this, but I would guess that this is how much funds some smaller banks have. So really, really remarkable what Aave has achieved. So let's look at how this looks like. You can see that there's different markets, so different assets that are listed on Aave, and each of those can either be lent out, so you deposit it, or you can borrow that asset. And there's a different interest rate for each asset. And the crazy thing about Aave is that it doesn't rely on any single company running this whole thing, or any humans handing out the loans and taking the user deposits and running all of this. It's 100% managed by smart contracts. So the smart contracts, they combine the depositors and the borrowers. And precisely how this works is that you see that there's different markets here for every asset that Aave lists. There you can either deposit it and then you earn interest on it, or you can borrow it and then you pay interest. So very similar to how things work at the bank. Now the question is, what determines this interest rate? So in the case of, for example, DAI, the average interest rate this year was 8%, I think. Right now you can see it's at 2.5%. So you can see that the interest rates are variable. It's not like some banks do where they give you 0.1%, let's say, for 1 year. Here it fluctuates. And it fluctuates based on supply and demand. So if there's a lot of supply of stablecoins, for example, like DAI is a stablecoin, if a lot of people want to deposit dollar stablecoins and earn interest on it, but there's not a lot of borrowing demand, so not a lot of people want to get a loan, then the interest rate will lower, because basically there's just a lot of people who want to earn interest and not a lot of people borrowing it. And so the interest rate is determined algorithmically by some smart contract, and it will automatically go down. Inversely, if a lot of people want to borrow some funds, but there's not a lot of supply, then the interest rate rises. So it's completely based on supply and demand by market forces. However, it can be said that interest rates have outperformed the rates in traditional finance by order of magnitudes. Because if you check in some European countries, you now have negative rates, and even in the US, the rates are super low. So this is partly why DeFi has been so popular in the last year. It's because there's so much economic activity in this sector unleashed by smart contracts and so on, that there's just higher demand for assets, and more economic activity almost always translates to higher interest rates. Now you ask, how safe is my dollar deposit if I just want to deposit it there and earn interest? Well, it's actually pretty safe, because in the 2 or 3 years that Aave has been live now, there hasn't been a single default. So no person who borrowed some funds didn't return them. And the reason for that is that if you want to take a loan from Aave, you can't just come up and say, hey, give me a loan. It is completely, like I said, automated on chain. And since Aave doesn't know your identity, who you are, and if you have money to pay the loan back, what they actually want in return is a collateral, a deposit. Similar to when you go to rent a car somewhere, you often have to put up a deposit so that the car rental company can be quite assured that you're not going to run away with the car. Or actually also similar to when you take a loan at a traditional bank and you put up your house as a mortgage, and then you can get a loan and the bank can seize your house if you don't pay back. Well, here it's similar. If you want a loan from Aave, you actually have to put up a crypto collateral. So if I want to borrow, for example, $10,000, I would have to put up $12,000 worth of Ether or any other cryptocurrency that I have. Once I have deposited that collateral, the platform has my funds, my collateral, and then it's willing to pay out some dollar loan. Once I have this dollar loan in my wallet, it's distributed, then I can do with it whatever I want. I can borrow, I can buy more of another cryptocurrency, I can send it to an exchange and convert it to like euros and send it to my bank account and spend it in real life. It's entirely up to me. So enough talking. Now that you have a rough understanding of how all of this works, let's dive into it. Let's try it out. So the first step that you have to undertake is to connect your wallet, and I use MetaMask. I've also shown in a video how to use MetaMask. Then you select an asset that you want to deposit and earn interest on it. So in my case, I'm gonna deposit some DAI. So I'm gonna click on my dashboard. Right now, I don't have any funds in Aave, so this is first time using Aave with this wallet here. So I'm going to click on deposit now. I'm going to go on DAI. And here you can see the app knows basically how much DAI I have in my wallet. And I'm going to lend, let's say, $5,000. And I'm going to click on continue. And then I have to approve the token. So here I have to approve the token. This is giving the application a permission to move dollar stablecoins out of my wallet and transfer them basically. So here I have to do this transaction on chain, and there's also a fee attached to doing so, because any transaction that you have to do on chain using your wallet will cost some transaction fee. Now you can see that the transaction has been approved, and I can head over to step 2, which is depositing. In case you haven't seen this, you can also check in your wallet. You can see that the transaction has been approved, and now I click on deposit, and you can see that here I have to do a second transaction, which is to actually deposit my DAI, my stablecoins into Aave. And you see there's a gas fee, a transaction fee that I have to pay to the Ethereum miners in order to get my transaction verified. So if you're not sure, so this gas fee, it's basically, MetaMask gives you a suggestion on how much to pay. But if you think you might be overpaying, I use this little extension called Ethereum gas price extension. And it tells me right now that I should pay 33 GUI for doing any transaction basically. So I'm going to check, 35, that looks good. Essentially, I don't want to pay much more than 33 or 35, around that, but I wouldn't pay now 50, because if I would pay that, you see that my transaction fee goes up basically. And I have an article explaining exactly how these fees work, but I'm going to go back to 35, confirm, and now the transaction is pending. So this means that it's submitted to the blockchain. I'm basically waiting for some miner to pick it up, put it in a block, and add it to the blockchain. I can also click here to watch it in in Explorer, but it hasn't been picked up yet, so I can't see it. So now this transaction has been confirmed as well on the blockchain, and you can even open it in Etherscan, which is an interface to the blockchain, and you can see a bunch of useful information about your transaction, when it happened, the transaction hash, and actually which smart contract was invoked. You can see I triggered this deposit function. Anyway, this is not super important, but I find it interesting. Basically, Aave gives you another token in return when you deposit, which is Aave. So when you deposit 5,000 DAI, you get 5,000 Aave. See this token here? I can add it to my wallet. And Aave increases in your wallet, essentially. So the token automatically increases in size to reflect your interest that you earn. You can also head to the dashboard to look at your 5,000 DAI, $5,000. You can see it grow, basically. Now, for many users, the journey ends here because you've deposited some asset, you're earning interest, you can lean back, you can come back from time to time, see that your balance has increased. But some people want to actually then also use their collateral, their deposit, to borrow some funds against it. Because again, to use that example from traditional loans, you can use your assets productively, right? You can use your house and go to the bank and say, look, I have this valuable house, can I please have a loan? And here you're saying, look, Aave, I have this valuable dollars here that you have as a security, and now I want to borrow some other asset against it. Essentially, how that works, imagine now I could borrow any crypto token that is listed here, but let's say I want to borrow some USDC, which is another stablecoin. Here, this example, it doesn't make too much sense, but I mean, you could, for example, borrow a DeFi token such as Sushi if you would want to short it, so speculate on its falling price. So then you would deposit dollar stablecoins, you'd borrow Sushi, you would sell it on the market, wait until the price of Sushi has dropped, buy it back, return it, and then you have basically pocketed a profit. That's called shorting. So there's a bunch of reasons why you would want to borrow funds. Here I just want to show you how you would do it. So you can see that there's a max button. So this is the maximum that Aave allows me to borrow in order for the loan to be secure for Aave. Because Aave doesn't want that some people default on their loans. That would be bad. So they have actually this calculation that looks at how much can a person borrow against their collateral. So in the case of my deposit, I can have, you see here there's a loan to value ratio. So I can, at most, I can borrow 75% of what I have deposited. So in my case, it was $5,000. So here I can borrow $3,750. I don't want to borrow the maximum amount of funds, $3,750 or whatever, because that's a bit risky. If I surpass the loan to value ratio of 75%, Aave would liquidate me, meaning it would take my 5,000 DAI that I've deposited. The reason I'm not taking the maximum amount that I can borrow is that there's some risk associated to doing so. So the loan to value ratio cannot exceed 75%. If your loan grows to 80%, for example, of what you have deposited, then you would be liquidated. And Aave does that because they don't want people to default on their loans. And in my case, I've deposited DAI, so it's actually quite stable as a collateral. And there's actually no reason to think that this ratio would change. But imagine I have deposited 10,000 ETH, so $10,000 worth of Ethereum. In that case, as you know, Ethereum is quite volatile, right? If we look at the charts, it goes up and down. And so if suddenly Ethereum drops in price, my deposit, my $10,000 would only be worth $5,000. But imagine now I got a loan when Ethereum was worth $10,000 and I got a loan of $5,000, then this loan to value ratio would be much higher than 75%. And what Aave does in that case is when it surpasses the 75% ratio, it takes the collateral, in that example, it takes my Ethereum and it sells it automatically. There's no human involved in that process. It's really just smart contracts automatically executing this transaction. And so this is how Aave never has any default of a loan, because it makes sure that borrowers always have enough collateral to secure the loan. So now I'm going to proceed with my loan of $2,000. Oh yeah, and you can choose between a stable interest rate that you can lock in for a couple of months. I don't want the risk of the interest rate changing. I mean, you can always, if you're not happy with the rate, you can always pay back. You see it's risen too much. I'll just continue, and then I click on borrow. Here I have to do another transaction. You see here 28, so this time I'll go down a bit. I'll put 30. I confirm, and now I wait. Great, so now my transaction has been approved and my 2000 USDC there in my wallet. I can see that assets in my wallet, 2000 USDC. They have been paid out, no questions asked. Beautiful. So this is essentially it. You can now look at your investment, your deposits, and your loan in your dashboard. You see everything. There's a health factor. So this tells you how safe your position is. Basically, if it starts to be low, basically you need to pay attention to it and maybe add some more collateral. So I would pay more DAI, or you pay some of your loan back. So this would bring it back up. And you see your current LTV ratio, loan to value ratio, which represents the maximum borrowing power of a specific collateral. There's an example here. Two more things I would like to talk about how this whole protocol is actually governed, because I said it's not a centralized company that runs all of this. So this website is actually just one of several websites that you can use. The real logic behind it is on the blockchain in the form of smart contracts. And this whole thing is really decentralized. So what that means is that the whole development of this protocol is governed by the community. So there's a token called the Aave token. So it's a bit like how a Facebook share or an Apple share allows you to vote in certain decisions of Apple, the company. Well, the Aave token allows you to vote on basically every parameter of the protocol. So for example, you can see that it determines what asset should be added to the lending market next. Important budget decisions, such as here a grants DAO, so that hands out grants, donations to people who want to build useful features for this protocol. Tokenomics, so how much fees should we charge and who should it go to. So virtually every important decision is handled by the community. Anyone can submit a proposal for something, and then people just vote on it and decide on it. The other interesting thing is how this token is then used for ensuring the protocol. So the people who hold Aave tokens, they can stake their Aave into what they call an insurance module. So this means that their tokens that are worth something will serve as an insurance to the protocol, meaning that if any loan goes bad and like the person who has taken the loan doesn't repay it, the money out of the insurance module will be taken. So if I have staked some Aave, my tokens will be sold to repay whatever loan has gone bad. As I said, this hasn't happened before. So there's never been a bad loan, but it is nevertheless an additional safety layer that should make depositors feel better about their deposits, because they know that if everything goes bad, there's still the insurance model that can cover some losses. It's a bit like if a bank hands out bad loans to people, then it will have to cover those loans out of its own balance sheet, right? Out of its own funds. Well, here there is no balance sheet because there's no company. So there's these Aave stakeholders who can put their money into an insurance fund. In return, they receive more Aave tokens. So the treasury basically allocates some Aave tokens to the people who take the risk, because they think that's something worthwhile to do. It's an activity that helps the protocol. You can think of it like an interest rate. So you stake your Aave, you take on risk, and then you earn like 20 or 30% per year in interest rates. It's quite a comprehensive protocol, but as a summary, you can just use it to deposit funds, earn interest on it, a much better interest rate than you get at the bank. You can also use it to take a loan, and you can do all sorts of useful things with it, such as, buying more crypto. So that's called a long position. You can short an asset. You can just, maybe have a lot of crypto funds and you just want to have some funds available to buy something in the real life, but you don't want to sell your crypto. So this lending market here really helps you with all of these things. I hope you enjoyed this video, and if you have any questions, ask in the comments.